There is no question that large companies have struggled to respond to emerging threats from new firms that break the rules of the industry. There is a long list of firms that either no longer exist or are mere shells of themselves. One study concluded that 50% of the companies in the Standard & Poor's stock index will be replaced by the end of the decade. The mobile phone company Nokia went from leading the digital mobile handset market in 2007 to being sold to Microsoft in 2013 for $7 billion, only to be written off a few years later. The music company EMI had a star-studded history of putting out recordings in multiple formats, from 78 RPM recordings and the Beatles' famous 33 RPM albums recorded at Abbey Road to magnetic tapes and compact discs. Then digital music and the business model that came with it destroyed profits, and EMI ceased to exist in 2012. We could name countless others, Kodak and Polaroid in photography and imaging, and Blockbuster and Debenhams in retail, and the list goes on. Disruption has no respect for age, geography, or industry. It can happen anywhere. Beating the odds. So why a book about corporate explorers? The answer is that in the nearly 25 years since Christensen's book was published, another reality has emerged. Big companies are learning to use their assets to beat the odds of disruption. Amazon, one of the world's few trillion-dollar value firms, has made the invention of new business core to its mode of operations. It is now not only an everything store and online marketplace, but also one of the world's most important technology service providers, with Amazon Web Services and a competitor to Netflix in the production and streaming of movies and videos with Amazon Prime. Technology firm NVIDIA saw the threat of being wedded to a rapidly commoditizing PC market. Even as its market share started to collapse, it invested in relaunching an artificial intelligence AI company. Meanwhile, Netflix was able to disrupt Blockbuster with mail-order DVD delivery and then pivot to create an online streaming service and, most recently, become a hugely successful content creator. There are large firms making multiple reinventions within 20 years and flatly contradicting the notion that only startups can lead disruption. They have learned to use their assets to create an innovation advantage. To be fair, many of these companies are relatively young firms with founder owners. They are often digital natives, still imbued with the spirit of entrepreneurship. This is less true for Microsoft. The software giant had for a generation made its money on software installed on servers and personal computers on a company's own premises. The onset of the cloud enabled an explosion of new services and solutions, from customer relationship management software, Salesforce, to human resource management, Workday. Disruption theory would predict that Microsoft should have been eclipsed by this software-as-a-service era. Instead, Microsoft reinvented enterprise email with its Office 365 online service, deliberately disrupting its own installed base of Exchange servers to create a new suite of productivity offerings. The same is true for less heralded firms like online information provider LexisNexis. 20 years ago, LexisNexis ran a legal and news information service for lawyers and corporations. It was a steady single-digit revenue growth company with high margins. Then, starting in 2001, it created a new multi-billion-dollar sister company, LexisNexis Risk Solutions. A manager won backing from his senior team to create a big data company, providing analytics and information solutions to insurance companies, government agencies, healthcare providers, and many others. Today, this new business generates more revenue than the old one. In each case, these established firms realized that they had a head start compared with entrepreneurs. They had resources and capabilities they could leverage. They had financial muscle, skilled people, production capacity, customers, and a whole host of assets that are beyond those of even a well-funded early-stage firm. Microsoft had an enormous base of existing enterprise customers that had their email exchanges installed on servers within the company. The Office 365 offering moved these email accounts to the cloud, cutting costs for the enterprise customers and creating a platform of innovation for Microsoft. LexisNexis had some of the assets that it needed: mechanisms for accessing and cataloging public records information, brand identity, financial resources, and where it lacked them it acquired, such as its data linking software. In many firms, these assets act more as liabilities, prompting managers to defend what they have. In others, these assets are understood as giving an advantage in getting ahead of disruption. What is different?